What's up, everyone? Welcome back to another episode of Fear-Free Passive Investing, where we talk all things passive commercial real estate investing. Today's show is really cool. We have Mr. Sakar Kawle, who owns and operates like 200 units in his single-family portfolio, but he's just now starting to move over to large commercial multifamily transactions, and he actually started by passively investing. So he has a lot of information about concrete steps passive investors can take so that they can make sure they're investing in the right stuff. And we also talk a little bit about how he used his experience of being laid off as sort of a catalyst to starting his real estate investing. So if you're in that scenario, or you're thinking that maybe you want to start having another source of income during this situation, you definitely don't want to miss this episode. So with that, I just want to start by saying thank you so much for everyone listening. This has been a really great month for the podcast and for Fear-Free Passive Investing on YouTube. We've had a lot of growth, so thank you again. If you're interested in checking out, whether you're watching on YouTube right now, there will be a link to the podcast in the description. If you're watching or if you're listening on the podcast, there will definitely be a link to the YouTube channel below. So make sure you're checking out both. There's different content on each. So with that, let's jump in and welcome Sakar. All right, Sakar, thanks so much for being here. I appreciate you coming on the show.
Sure. Thank you, Lucas. I appreciate you having me.
Yeah. I appreciate the waking up early on a Memorial Day and being here and talking real estate with me. It's always nice to have some friends that are committed to this, so I appreciate that. But for those who might not know you, can you just take like maybe a couple minutes and just explain who you are, how you came to be passively investing in real estate, and maybe some other stuff you've done along the way?
Sure. So I'm Sakar Kawle, and I have a kind of a full round story wherein I started with single family rentals back in 2001, and went through a whole corporate career, quit the job through just the power and assurance of real estate, and then sort of realized the bigger is better, and learning the benefits of syndications and also the larger multifamily in general. That's how I came around into passive investing. So just dating back now, like at my IT career back then, I started working in 99, and very quickly within 2 years, I had the layoff. And that was a sudden shock wherein that's where I was looking to have some assurance around hey, what my life is going to be. You don't want to be, on a sort of on a visa at that point, and then get laid off. And then, that was all the uncertainty I was trying to gain some assurance regarding that. So that led me to search into real estate, and my family has a lot of real estate background as well. So I started searching that, okay, how a common person can invest, into rental properties or do real estate. So came about, cash flowing rentals, and currently I live in Maryland. That's where my job was transferred back then. So I was working at a mutual fund company here. And that's when I realized that, hey, you know what? Baltimore is definitely a cash flowing town. So I started with, first rental, second rental, and things like that. And at this point, we have close to a couple of hundred single family townhouses and some smaller apartments and things like that. So as we started that, a lot of it was, just renovations, repositioning one at a time, and our cash flow went up. Then I was looking for, larger deals. And that's when I started investing into, let's say, syndications, or I bought my own, multifamily apartments as well.
So you touched on a lot of stuff there that I want to go back to, but just real quick, you have close to 100 single family homes, townhomes, duplexes, things like that. Why make the shift to multifamily? What do you see in multifamily that you're not seeing in those single families?
Right. So just to correct you there, we own about 170 some.
170.
Yes.
Wow.
So our total portfolio size is about 200 units, right?
Okay.
And a lot of it is pretty much townhouses, some single families, and things like that. And like several years ago, I mean, as you can realize, we done a lot of like acquisitions, and we will group the houses into, let's say, 10, 12 houses and go and refinance, right?
Oh, yeah.
So a lot of times I would have a lot of cash that I was holding on. So I was looking for a proper way to invest in those, right? And then when I invested into, let's say, a 7 unit or 10 unit and things like that, that's when I realized, hey, you know what? Definitely bigger is better, because you are, of course, gaining the efficiency. You have, a sort of one roof, you have management in place and things like that. And that's when you start to realize that, hey, definitely bigger is better. You're not running around. Fortunately, all our rentals are definitely concentrated in probably 2 or 3 zip codes, which makes our job easier. But again, when you try to really look for those efficiencies, it's definitely that bigger is better, and you have all those benefits of tax, you get K1s and things like that. So that was really my sort of attraction towards multifamily, I would say.
Approximately how many hours do you think you were spending, and maybe you self-manage or you have a management company, how much time were you spending on that, close to 200 unit portfolio?
Right. So at this point, we are quite controlled. Actually, we are not spending that much time. Personally, I don't spend that much time. I have staff around me and stuff, right? But again, we still deal in a lot of, like, let's say, a voucher based or Section 8
Oh, yeah.
type of properties as well. So we are very active. I have been active and done double duty. In fact, my wife is also active in the business, so a lot of my share also goes to her. That we both have championed the business, right? So we knew from get-go that yes, this is what we want it to be, and we scaled it up that way as well. But again, when we started that, hey, when we are seeing this much cash and these many rentals, we did not want that. I mean, we have our office staff and things like that as well. So typically my day goes is that probably in the morning, 3-4 hours, I kind of set them aside for our business and things like that.
Hmm.
Now it is pretty much on autopilot, where we have our own maintenance people, our own staff that are doing things. And now this allows me to also source our own deals into multifamily, look into larger projects as well.
Hmm.
And plus, as you know, I run a podcast as well called Premium Cashflow Podcast. So I kind of divide my time that way, basically.
Yeah, and so you're definitely wanting to source your own deal. You're wanting to be on the general partnership side. You have been, certainly, but
Right.
you started in the large multifamily syndication world, passively investing. Let's talk
Correct.
about how you got to that point, how you got comfortable with those syndications, and what you saw to make you want to wire money.
Absolutely, absolutely. And we can look at it in many different ways, right? So I came full circle as well, like back in, let's say, 99, 2000, came through the stock market crash,
Hmm.
as a lot of people experienced. Then obviously we saw the crash as well in the 08, 09 era, right? So I knew all along that stock market isn't the sort of the security. Where I used to work as well at the mutual fund company, we would see the charts and what's coming, what's the forecast and things like that. So we would see how uncertain the stock market is. And so when you have 500,000 or 600K is literally in your checking account, it's like, oh my God, I mean, I'm not investing it properly. Then, 6 months, 8 months, 12 months go by, you're absolutely motivated to see that, hey, how can I secure this? And all along, if you can realize, I would have my own portfolios, and I know that, okay, we bought deals by cash, right? So all our deals would be like 80,000 to 100,000 per house, right? So how many you want to buy, right? I had financing and things like that. So it's really the guarantee of the multifamily is what motivated me. Then you couple in other benefits, such as, okay, the operators, how they are operating, right? So I see that firsthand from a lens of how I am operating my portfolio, how the general partnership group that I will be investing into is also going to operate. So those are kind of the very much the sort of on the ground practical benefits that someone has to look at it, saying, hey, is the operator responsible enough? Are they reporting it correctly? Are their assumptions conservative enough? All those benefits really sort of start to give into that, hey, multifamily is a very assured asset class, and that's how you get benefits. Then coming to the, let's say, the investor side, which sort of I am, I am considered what on a tax return as a professional status, which allows me, greater depreciation and a lot of other benefits that come with that, right? So when you look into that aspect, right, so you get a surety of who the operator is. You are getting the depreciations as well. Then there's something called the bonus depreciation as well, that you can have your greater write-offs, so your depreciated income is a lot more. So all those benefits lead into that, hey, definitely the multifamily not only works, it's really the safest place where you can be. And if you kind of look at it at a sort of a global level, right, on a common sense basis, you can see that apartments in general are sort of the common lowest denominator that someone can be. You have to have roof over your head. So when you sort of combine all these benefits and all these stats, the picture becomes very clear. Like, I mean, we are just past the, all the high rise of the COVID pandemic, right?
Mm-hmm.
The April, May results have already come out where they said that, hey, if you see the rents of, let's say, March, April, now May, they have been pretty stellar. They haven't gone down as much. So that's also another reminder that how resilient the multifamily class is, So that's kind of how I would sum it as to why, I kind of came around into multifamily, not only from a passive side, but also from an active side, sort of seeing that lens of how operators operate the deals and things like that.
Yeah, that's really important. I think what you touched on just now about how we're starting to see, at least it's trending back towards normal. However, we're also seeing that multifamily has been shown to be like this stable asset during this crisis. And I think that a lot of money is going to be pushed towards that. I truly believe that all the people that lost money in hotels or even single family homes or office space, whatever it is going to start flooding into multifamily because of what we just witnessed.
Very
Now, of
true.
course,
Very true.
yeah, of course, nobody knows what's going to happen, but that's just my point of view. But I want to go back and touch on, you talked about how you got laid off, and that was really kind of a focusing event for you. I
Sure.
imagine that some people might be in that situation right now because of this situation. What are some concrete first steps that you can recommend to them, even if they haven't lost their job? Maybe they just want to start securing that. What are some concrete steps that they can go through to start maybe promoting themselves on that other like side hustle almost, or real estate investing hustle that they can start on today?
Right, right. That's a very good question. And thank you for asking that, Lucas. Um, one thing I would say to a lot of people is that investing doesn't have to be large and big. Sometimes we see the, lot of bigger people who are doing these things or on a very larger podcast and stuff. I don't, recommend anybody to get swayed away. Look at, I mean, if you lost your job, geez, I mean, 3 or 4 rentals that perhaps you may have, uh, those would be your magnets. That those are kind of right now showing you that, hey, you know what, I got some security, or at least I have some income from those rentals right now. So it doesn't have to be big, right?
Yeah.
But again, as you start becoming a bit more sophisticated, you have to look at it in a very sort of practical way as to, okay,
Mm-hmm.
are you providing safe housing to all your tenants, right? That's kind of, to me, is the first and foremost. Then are your renovations done correctly? Like, are you doing things in a good professional and an ethical manner? Those would be the key things. Like, for example, if someone has not even started, It could be as good as going, hey, let's take a different route, see how cash flowing works. Sort of knowledge and action is your base. Knowing that, okay, how cash flowing rentals work, right? If you're like, let's say, even looking for a first rental, depending on where your geographic area is, typically you will find these neighborhoods where it's not like the highest class of people living there. These are more blue collar workers and things like that. So that's where you want to focus, is that look into those areas. Perhaps if you're driving, you may have to go drive 1 hour, 2 hour for that
Yeah.
matter. But all those areas do exist, and that, I mean, those areas doesn't mean that, oh, hey, they are bad or anything like that. Just look for those safer neighborhoods.
Yeah.
And there are schemes, and there are all these different avenues that you can look at it, right? But the last thing you want to do also is that just look at your sort of the headline on your newspaper saying, hey, there are like maybe 2 murders that happen overnight, and don't let that bad negativity sway you from anything, right?
Hmm.
If you go to those neighborhoods, you find, hey, you can drive easily, there are safe cars there, and those would be the neighborhoods you want to start looking into.
Yeah.
Network with your fellow real estate professionals, or investor clubs for that
Mhm.
matter. You will start to notice that, hey, these are all the different people who have already invested in these neighborhoods, and that gives you first confidence that, hey, these are 5 other investors who have invested into these neighborhoods.
Yeah.
And start from there. Doesn't have to be as big as anything. I mean, I'm an immigrant, right? So I started from one house, two house, three house. Now, we have a larger portfolio. But I always keep my head down. I'm always sort of on the ground, interacting sometimes with tenants and things like that as well. So I never, get my head up. So
Hmm.
for someone starting, that's what I would say, is that it doesn't have to be big.
Yeah.
You can do great just by even 4 or 5 rentals, and scale it from there. Doesn't have to be as big as what the other biggest podcasters or a lot of gurus might be telling you.
Yeah, that's a good point. I think when you have one of these focusing events, say you lost your job or you're scared of losing your job, or this COVID situation might have actually been your focusing event that you say, hey, I want to start diversifying my income. I think a really good first step is to determine what is your time worth. Now, if you're making a lot of money, like well over 6 figures, or maybe even 6 figures for you, and your time is very valuable to you, passive investing might be a really good avenue for you. If your time is worth less than what you're making, you might want to start with those 3 4 rentals and start building that up. I think that's a great strategy, like you mentioned.
Sure.
But definitely keep in mind your time value of that dollar, because I do think that passively investing is probably a really good, easy first step for a lot of people.
You're absolutely right, Lucas. Even for high net worth people who have, let's say, a lot of good cash stayed aside, like, for example, I have a lot of good friends who are, let's say, owning businesses and things like that. It all depends on, what sort of stage of your family and your career you are in, right?
Yeah.
So definitely, even if you are focused on investing passively, I mean, there are a lot of good markets. There are a lot of good operators where you can invest and probably secure your money and even double your money in 3 to 5 years as well.
Yeah.
So you're absolutely right about that.
Yeah. So you touched earlier that on some basic things that passive investors should be looking for as far as assumptions. I'd like to dig in a little bit more. If I'm a
Sure.
brand new passive investor, or maybe not brand new, but what would you recommend that people pay attention to when they see an offering come across their desk? Assumptions, cash on cash returns, whatever you decide, what should they be focusing on?
Sure, absolutely. That's a good question there, Lucas. What I would say is that first look at what the submarket is, and submarket is sort of the state or the corner of the state where people are looking to invest. Right. Very simple thing that anyone can do is say that top 10 growing states. You can just Google that, and you will come up with a list. So
Mhm.
that kind of tells you that, hey, the occupancy and the population growth is definitely there in this submarket.
Okay.
Sometimes, you see a lot of, large numbers that come across on the operating memorandums, as we call it, the OMs, right? And that doesn't, like, although they look good on paper, but that doesn't mean that it's a great deal. It could perhaps be a very risky deal because it's in a very like a very crummy submarket, where I think it's touted to be giving you big returns, but they are laid with a lot of risk.
Hmm.
So you have to kind of evaluate the submarket first. I would say do a good due diligence on who is running the deal, meaning who are the general partners involved in it. What track record they have. Have they done good investing, or do they have a good background of doing those things, right? And then once sort of some of those check boxes check out, then dig into, if you can, is, hey, understand, if you have the privilege to get their underwriting, maybe perhaps look into that. Okay, are their rent projections very conservative, right? So now we are into, let's say, going through this COVID pandemic right now, right? So a lot of states have frozen the rent increases, the late fees, and things like that, right? So
Hmm.
in fact, just a couple of days ago, I saw an OM where someone was like increasing their other income category, which is basically late fees, application fees, and things like that. They had, I think, other income for around 48,000 or something like that, and in year two they were projecting that same other income to be like 84,000, right? So
Wow.
that's a serious red flag, right? That you want to see a conservative estimate, like, going back to what I was saying earlier, is that you probably want to see that the rent growth assumption, at least through the pandemic season that we are in, probably is just flat zero. Like,
Hmm.
you're just staying the occupancy, maybe doing some light renovations and things like that, and then look into year two, year three, increasing that rental income. So those would be the highlights. Then
Hmm.
as you start off, maybe get deeper into looking at the OM, understand where the value or where the asset is going to increase, or meaning where, how, basically you have to understand that how the returns are going to be generated, right? Whether it is value add, or whether it's like just the appreciation in general. I mean, the technical term they call it is IRR partition, but that's meant between cash flow and appreciation. So you have
Hmm.
to understand all those things. Those would be the kind of the really low hanging fruit that someone should look at, those things basically.
Yeah. So just to summarize, some looking at the submarket, looking at the operators, their track record,
Sure.
looking at their income projections, both rent and maybe other types of income, and
Sure.
then looking at how the return is generated, whether it's more of an appreciation play or whether it's more of a cash flow play, risk
Right.
reward, higher returns mean higher risk, that type of thing. Is that
Right.
fair?
Right. Right. Absolutely. Absolutely.
Good, good. Yeah. And so, I think this is brilliant. That's a perfect way to start. And that'll get you probably 80% of the way. And then you can kind of fine tune from there too. I think that's a great um, start. You talked about knowing the operators. How important is that?
Absolutely. I think one of the things we have to also clarify is that when you are investing in stock market, you're not really knowing the company. You're just going by charts and stuff, right?
Mm,
But in multifamily or a lot of commercial assets, when you're investing, is that power of knowing the person that who's doing it, right? What they have done before, right? If they have a prior experience and things like that, what's their sort of reporting style and things like that. I mean, one of the nice things nowadays is that, hey, you can search anybody on let's say Google or a YouTube or different news forums
hmm.
and things like that, right? So you can understand what their track record is, right? So once you understand that global picture, and you want a very conservative person who has done these prior things with integrity, whether doesn't have to be multifamily, or just doesn't have to be any specific thing. It could be their prior business and things like that, right? Those are the things you want to look at, right? And once you have that, then understand what their management structure is, who's going to manage the assets, and what the property management and things like that are going to be. So you kind of know the entire sort of the operational side of the investment. And once you know that, you feel comfortable. That's an easy way for you to feel that, hey, I want to invest my $50,000, $100,000 into these deals, and know that, okay, you will have a better sleep at night. I mean, that's at the end of the day, you see it. And once you understand that, okay, how assured you are with the operators, right? And then what's the value play, or what sort of the status as to how they are going to increase the value, and how your returns are going to be generated. That's how you kind of invest into these things. And of course there are some other more details into it, but those are sort of, I would say, highlight points as to how you go about these things.
Okay. That's great advice. So, just to wrap up, I want to be respectful of your time. What advice would you give to someone who's interested in passively investing, but they're scared to take that first leap? They're fearful of that.
Absolutely. That's a great question. I think one of the things you have to look at is, as you pointed out earlier, like, what is your time worth, right? Like, if your time, you have a lot of, you're busy professional, right? You don't have time, but you want to know the different operators, understand the submarkets and things like that. Once you have that powered with that knowledge, then you start investing into it. You might invest some money before, but this is an assured way to probably double your money, because the math just works. Like, if you understand, if you take some some understanding of why commercial assets, through technically it's called cap rate evaluation and things like that. Once you understand how this model works, and how different operators, whether they are increasing the rents or reducing the expenses and things like that, so that net operating income, as we call it, once you understand how those things work, then there's a lot of assurance as to your money will be protected. Not only protected, your capital will of course increase and things like that, and you throw in some other benefits as far as taxes and things like that. Those would be the definite things that you have to look at, and that those are the highlights that I would definitely say that why you should look into commercial assets for investing.
Yeah, you made a good point. Math, the math just works. And frankly,
Absolutely.
it's a lot easier to understand, and people make it a lot more complicated than they need to be. As long as they're following some basic rules, the math just works. I think that's
Absolutely.
great.
Absolutely.
Well, thank you so much for being on the show. I think this has been really helpful. Where can people learn more about you, and maybe take a couple minutes and talk to us about your podcast and what it's about?
Sure. So my podcast specifically is called Premium Cashflow Podcast. Our company is metropolitan as far as our single family business and things like that. But typically people can find me on Premium Cashflow Podcast. That's where we run our multifamily division. And we have, opportunities for investments all the time.
Mm-hmm.
We interview a lot of expert guests as well on our podcast. And that's where I would say that people can learn more about me. And I kind of came from a full circle of investments, from single family, doing, different business ventures, and now doing syndications as well. So I kind of have that full circle where people can learn about me, and I'm always active on Facebook and things like that as well.
Yeah, I'm sure there's a wealth of knowledge on that podcast.
Absolutely. Absolutely.
Yeah. All right. Well, thank you. That'll all be at fearfreepassive.com if you want to check out Sakar and his podcast and get in touch with him. With that, thank you so much. I appreciate you coming on.
Thank you, Lucas. It's been a pleasure.
See you soon.
See you. Bye.